From the morning reading, diamonds, IWM, Spider paused after new highs of last week. Breadth weakened compared to the prior session as decliners led 1893 to 1032 on the New York Stock Exchange and led 1693 to 1693 on the NASDAQ. On the S&P 500 snapshot, the presidential election rally decision takes a pause. After setting 4 consecutive record closes in the presidential rally, the S&P 500 took a pause today. The index opened lower and sold off in a couple of waves to its negative 0.59% intraday low shortly before its slightly trimmed negative 0.53% closing loss. The 500, along with its cousin U.S. indices, the Dow and the NASDAQ, followed the pattern of the major European indices, which posted slightly greater losses. The DAX closed at negative 1.09%, the CAC at negative 0.88%, and the FTSE at negative 0.60%. Optimism has reached risky levels. The spread between smart money confidence and dumb money confidence has exceeded a threshold that has consistently led to subpar returns in stocks over the short to medium term. Momentum is returning to the market. Measure of momentum of the breadth underlying stocks advance has turned positive after a brief respite. The McClellan Summation Index has been below zero for a few weeks after having shown extremely positive momentum earlier this summer. Theoretically, such a brief period of negative momentum, followed by an extended period of positive momentum, should be a good sign for stocks. It was longer term, but not as consistent as one would think. Small caps finally ended their streak. The Russell 2000 string of positive days ended at 15, one of the longest in its history. Other long streaks have ended with a thud, but that didn't dent future returns. Over the next month, in particular, small caps tended to shine. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:43 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 29th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive in to the key headlights from the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were basically just above scratch. Crude oil, though, has made a big move in the overnight, down well over $1 or some 2.5%. Euro is down just below scratch, as is the long bond. Gold is down about 0.5%. China up just above scratch. Hong Kong down about 0.4%. Japan down about 0.25%. Germany on scratch, and the United Kingdom down about 0.5%. And macroeconomic reports for today of note for the United States. We have the preliminary GDP, FOMC member Dudley speaking. Consumer confidence, FOMC member Powell speaking. And I don't have tomorrow because there's so many reports on both today's and tomorrow's, I couldn't fit them on the report here. In terms of current volatility conditions, you can see the short-term VIX did get a bit of a pop yesterday, bouncing from the 10 handle up to almost 13. 12.86 was the final number. On skew, just above the warning area at a 126, so there is a little bit of concern there about that number. IV percentiles, though, are all very, very low, though they're somewhat higher than they were over the previous session. The S&P at a 20, the Russell 24, the NASDAQ at 15, and the Dow at a 22. We did have standard deviation size moves in 2 of the indices yesterday. Both the S&P and the Russell were down by more than 1 standard deviation on the close-to-close price method. In terms of the current charts, we'll start with the S&P futures, and you can see how during last week, of course, we had the new all-time high at 2211, And yesterday's session after the holiday weekend did back off from that. So far today, we've retraced some of that. Yesterday's candle's a bit bearish, especially when you consider that it's a fairly large body. It opened up here and closed all the way down near the lows of the day, but it didn't really break down. It's not even below the price action of the previous 2 days. So right now, this is just a very, very mild retracement. Frankly, would not be surprised if we get a pullback more like in line to the 2200 and then resumption of the bullish trend. So we may be set up for a little bit of very short-term weakness right now, and then followed probably by a more longer-term bullish period. That's the primary expectation. If we start breaking below 2200 and we get a good sharp confirmed close before 2200, then we're likely back into the slop of the sideways action and have failed once again to have consistent higher highs and higher lows. So that's the fear. If we break back down, we'll see if that happens. That's not the first expectation as it stands right now. In terms of the Dow, same kind of action here, and this consolidation yesterday, very, very small, very mild thus far. Now the Russell, of course, had something a bit more pronounced, and remember, we had an overshoot of this channel, and right now it seems like we have come back and closed right at the channel. So we'll wait to be seen as to whether this overshoot resistance now becomes a support area. Thus far, the short-term action it has. I frankly kind of expect it to fall back within the channel, but to continue a bullish action. We'll see. Been very interesting watching the Russell in the last 15 days. I mean, 15-day up session is pretty remarkable. And then the NASDAQ, of course, has been bumping its head right up underneath the resistance area, and has yet to follow through. The other three indices have broken out to new highs. NASDAQ has failed to do that. We'd like to see some gathering of energy and momentum from this tech sector. These are many of our higher beta, more growth oriented, often don't pay dividends. And, if we could see this group start to take a stronger leadership, we'll probably see the broader market also in a stronger bullish trend. In terms of other markets, let's take a look at crude oil. We've had quite a bit of volatility in crude oil in recent days. You see the big red candle here, followed by a large green candle, followed by a big red candle. It's been pretty choppy, but overall, if you look at where you started from, say a week ago, you started, say, here, and then right now you're just a few cents below that. So while there's been a lot of action since the start of this big green candle, it's all basically in the same area. We are indeed still neutral in the intermediate term market posture, though you have to recognize just because you're neutral doesn't mean that it can't have volatility. And gold also has been doing some bit of a bounce. We've had some action in the dollar. Dollar has had a bit of a retracement, but seems to be setting up, and hasn't quite fired yet, but seems to be setting up for a bull flag breakout. And if we have the dollar trade at approximately 101.83, that would be an entry point for the next leg up on the dollar. If that happens, then you probably have action on gold and crude and other markets such as bonds, which continue to show just parabolic weakness. And you had a new 52-week low come in with the session on Friday. And here's notes. Okay. And let's take a look at volatility. Volatility, of course, did pop a little bit yesterday. but from very, very low levels. And overall, these levels, right now we're right around a 13, very, very low. This is the range of bull markets, 12 to 15. So all this action between the 12 to 15 area is fairly benign, and just your kind of your just general noise of a bull market. And once we get up above 15, we start looking at that as something more serious for sure. Let's go ahead and go to the daily report. We did have some changes here from yesterday, not so much at the top. Intermediate term phase opinion, still market phase 3, bull flagville, and I think that's probably what we're getting ready to set up right now, is some bull flags on the bigger markets. Intermediate term market posture continues to be a severely strong bull, and you see these numbers are pegged just about as high as they can be, and that's supported by a weak bullish sentiment line. When you look at the 3 market timing signals, the first one coming to us from IBD, confirmed uptrend, that's bullish. GMI index absolutely pegged at the strongest scores on both the GMI index and the GMI2, buy signal in place since 11:10. On the stock charts decision point scoreboard, no changes from yesterday. We're still waiting to see gathering of strength on the intermediate term and to follow through ultimately to the long term. Position sizing opinions on both models remain at 100%. And in terms of the hedge warning status, 0+, normal with some elevated conditions. The 3 strategy opinions are all the same as yesterday. VIX is inside the acceptable range for the option income strategies, cover calls, and put selling. Obviously, also giving a positive opinion for the initiation of new positions by even novice traders. Some conservatism still here. Remember, we're still waiting to see if we can get a higher high and a higher low. We've gotten those higher highs in 3 of the 4 indices, but does that hold? Does it fall back into the trading range until we kind of start to see more of a bullish trend with a sequence of those higher highs and higher lows? We'll have a little bit more of a conservative ratio here. Right now, the opinion is 1-to-1 ratio in the money, out of the money strikes, and the 1-to-1 ratio in the low beta versus high beta positions. Might be able to take advantage of some of these weaknesses that are being expressed in the markets in the next couple days to get some put selling positions off of your watch list and get those opened up. So be watching for those kinds of opportunities. In terms of the specific warning areas, we did have quite a few flag with yesterday's weakness, but put this in context that the overall VIX is still in that 12 to 15 zone. So these are fairly weak warnings compared to other times when we see the same kind of red and we're in a higher VIX level. But in terms of change and rate of change, we have to respect that we started to see some of this roll up. Market in decline, sharp increase warning. The volatility ratio did fire. We talked yesterday how it was in a firing position but had not yet fired. That did happen with yesterday. Also, the distribution day count ticked up. NASDAQ going to an 8. Skew is just above the 125. So that's also in warning status. And also the current 10-day out expected move ticked up on the SPX to up over 40. Now, those are all in the volatility area in that we did see a little bit of an uptick in volatility yesterday, but in other areas that look at the market from different perspectives, we really didn't see much yet. Under the trend-based area, they're all still very much bullish, and the new highs, new lows yesterday was even 348 for the new highs, even on a day of weakness. The intermarket risk aversion indicators, all 5 are still risk on, though some are starting to show some rolling over behavior. So we'll continue to watch that and see if they start to fire some warnings. In terms of the sentiment in the market right now is at 70, so actually went down a couple notches from the previous session. And then from a sector specific, you can see it was fairly weak yesterday, but where you did have green was in some of those overshoots to the weak side from previous sessions. Utilities, telecom, real estate, consumer staples, all the more defensive-oriented sectors. And these have been the sectors, frankly, that had not participated so much in the current sector rotation, which had been more of a risk-on, higher beta, financials, industrials, materials, and so forth, that have been largely doing well since the post-election decision, at the expense of utilities and so forth. So very much, as we had discussed, we had seen some probably parabolic moves in some of those. Financials, a great example of that, and utilities in the opposite direction. Kind of parabolic moves, and that there would be some overshoot and then some correction to bring that back together. I think that's probably a lot of what we saw yesterday's action. In terms of market postures across the three time frames, you continue to see consumer staples, healthcare, and energy as the three weaker sectors. Do note that utilities now has gone to up, up, and up. So from that period of weakness that utilities has experienced, definitely have seen it recover. Take a quick look at the chart. You'll see what I'm talking about. Now, right now, this is a series of lower highs, lower lows, below the cloud. The move that we've had of recent has moved up through some key moving average lines. It's now approaching the bottom of the cloud. But until we see it start to break the swing highs and break out above the cloud, we don't really have a confirmed intermediate term trend change, but we certainly are seeing signs of a challenge to that at the very least. So we'll see if this does manage to get a bit larger of a move. It's kind of hard to believe that it can actually get all the way up here and change this trend against the expectation of interest rates, especially with the December just a few weeks away. We'll likely see the continued deterioration of sectors such as this. So what does that mean? If you're in a position, you might want to consider, an exit point. If you're wanting to not hold on for the long term, you might have reasons to hold on for the long term. But this is probably a pretty good bounce in a market that, much like the bonds, is still probably in the longer haul, still looking at a trending weakness period. Okay, I think that's probably enough for today. Let's go ahead and roll this thing up. I'm going to roll through these slides here. If you see anything of interest, just hit the pause button, and you can go to that hyperlink and get additional information. I will note here, if you ever have any comments, feedback, support, hey, you just want to give me a pat in the back because, hey, I'm doing this for free, just an email to support at falconglobaltraders.com. That'll get it to me, and always welcome those comments. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here next for tomorrow's market preview session from Falcon Global. In the meantime, make sure you manage that risk. That'll give you the consistency that you're looking for. And then each and every day, go out there and seek to learn something about your chosen craft, investing and trading. Good trading.